socionomics and what we were discussing today with regards to sentiment on the dollar stock market and herding, et cetera, right? Because isn't this in reality the experience of most investors, what they go through in the markets?
Yes, and there are some people who try to argue that everybody in the aggregate adapts to situations and they figure things out and they reason them out and therefore they become good investors. Well, one person in probably 5 or 10,000 can do that, but almost everyone else cannot help but reasoning from physics and saying that, okay, well, if the economy's better, that's going to push the stock market up. You know, this outside billiard ball is going to come hit the stock market and make it go up. They've got the causality backwards, but they still can't let go of that default way of thinking because their unconscious mind is impelling them to take certain actions based on their mood, while at the same time, their conscious mind has to do something. It can't just sit there and go, well, I'm feeling better, that's why I'm buying stock, because your conscious mind isn't satisfied with that. Reason is not satisfied. So what does it have to do? It has to come up with a story. It has to come up with a reason to justify the fact that you're just about to push that buy button on your screen. So you know, some new news event comes along and you say, well, that suffices. This is a good reason for me to buy them right here. And so then your reasoning brain relaxes and said, well, I've found a good reason, so I can go to sleep now. And then the unconscious mind just sits there and chuckles, saying, I got exactly what I wanted.
Does that explain, because this was also from your piece, most investors can quickly rationalize selling an investment because its price is falling or buying it because the price is rising. But there is not a soul who desperately rationalizes doing with less bread because the price is falling, or who drives his car twice as much because the price of gasoline has doubled. So I guess this gets back to your other part there where it's again and again and again people keep doing the wrong thing. Does that explain that?
Yes, because of what we talked about earlier. There is a fundamental difference. The title of the paper that we wrote for the Journal of Behavioral Finance is the financial economic dichotomy, meaning that there is a complete split, in my view, between how people behave in the economic realm, in economic markets where supply and demand rule and equilibrium is the result, and that's in the Walmarts of the world and other places where you're getting personal value for your money. And so you rationally want to get the best utility you can out of it. And on the other side of the spectrum, we have finance, where people, as we can see by the record, are in the aggregate always doing the wrong thing. They're selling as the market gets cheap, and they're buying it as it gets expensive. So you can't explain it with economic theory. That is what the efficient market hypothesis tried to do and has pretty much failed. And I'm hoping many books have been written in the last 2 years about the failure of economics and the failure of economists to see what was coming, and they all have the same complaint. What we need is the theory to replace it. And I think it's time that the wave principle, as a patterned way that waves of optimism and pessimism are regulated, the idea that those waves of optimism and pessimism are causal to social action, and this explains everything that we see from market movement to what we read in the newspaper, I think it would change people's orientation entirely and give them that new bedrock theory that they're looking for.
In closing here, Bob, for anything you want to add to this, but I'll just kind of set you up here. Can you contrast the two depressions? Meaning, will the socioeconomic climate in front of us resemble in any way the socioeconomic situation of the last Great Depression?
Absolutely, and we've also looked at the depression of the early 1840s as another model. Both of those, however, which, as I mentioned earlier, are of smaller degree than the bear market we're in now. So this depression should be much bigger. And I think anyone who studies the precursors of depression, which is credit expansion, can see that the credit expansion of the 1990s was the biggest by many, many multiples, bigger than anything we've seen in the 200 years this country's been around. So the setup, I think, fits the Elliott Wave interpretation perfectly. And that's why I was, I had the nerve to write a book about it, because I took a deep breath and said, if there's any time in my life when I have to tell people a major wave is topping, this is it.
Let me ask you this, Bob, for the people out there that are wondering if things can just keep going along or be business as usual, because as you said, Bernanke will come out, and the economists, we have 90% of them now, right, that are saying we're going to come out of over 90% saying we're going to come out of the recession, if they want to call it that.
Yeah. This quarter.
Right. Well, yeah. So I guess where I'm heading with this is that whether a Dr. Mark Faber is right and we have hyperinflation, or a Bob Prechter is right and we have deflation, putting that aside, Bob, isn't it safe to say it will not be business as usual going forward, and that this country is in for tremendous trouble and a very torturous situation going forward?
Yeah, bear markets always bring tremendous social trouble. And we could end up with both hyperinflation and deflation. I'm arguing that deflation has to come first. These guys are saying hyperinflation has to come first. I mean, I guess we'll find out who's right eventually. But the 99% of economists who think, well, we just had a normal recession and it's back to the old ways, I think will be wrong, because the degree of the turn is that important, that large, and that impactful that we're going to remember this period for a long time. But even though we're saying some bearish things about markets and what's going to happen in society, there's something that I absolutely have to stress, and that is the reason I wrote the whole second part of Conquer the Crash. You do not have to participate and suffer from most of these trends. If you had some wealth to protect and you put it all in the safest possible cash equivalents in the safest institutions in the world, you didn't lose 50% of your money in real estate. You didn't lose half of it in the stock market. You didn't lose 57% of it in the commodity markets either. You simply held on to that money, which is now beginning to grow in purchasing power. You can buy twice the land today that you could in 2005 for the same dollar bills, which is an amazing thing. Price of gasoline is down from its peak, and I think we're going to eventually see many producer and consumer prices falling. That's usually the last area of price decline. So if you're holding on to your money and you're not following the siren songs of all these people that said you need to be completely invested in the stock market for the long run and all that, you will be one of the very rare investors who is going to have purchasing power when the markets finally do bottom out. I think it was Baron Rothschild who said, buy when blood is running in the streets. Well, that's a little bit graphic and maybe overly dramatic. But the point is, when everybody else is very, very worried because their pessimism is at a complete extreme, as it was in 1932, 1842, and times like that, they don't want to touch the market with a 10-foot pole. That's where a socionomically trained person would come in and say, this is where I want it. I want to buy this stock that's down 99%, and I'm pretty sure the company will keep going, because all it has to do is go back from $1 to 10, and I've made 10 times my money. Those are the times to really get rich.
Bob, let's talk about where people can go. Do they just go to Elliott Wave International if they want to learn more about socionomics, or how do they do that?
Well, if you're interested in financial things and markets, you come to ElliottWave.com. That's 2 L's and 2 T's in Elliott, wave like on the ocean.com. We have a lot of free stuff, too, so you don't have to spend money when you get here. And if you're interested in socionomics, then I would suggest coming to Socionomics.net. That's where we post all of our socionomic work.
And I'll have something next to your picture there where people can just click on that and it'll link directly over. Also, Bob, if they go there, they can get the paper for free, I guess, now that you did with Wayne?
Yeah. I think if they go to Socionomics.net, we have a link to the paper because it's now over a year old, which means they allow us to give it away.
Okay, terrific. Thank you for being here, sir.
Yeah, it's been fun talking.
Thank you for joining us at KingWorldNews.com. Remember to tune in next week for another great show where we will have Rob Arnott, who manages $30 billion over at Research Affiliates. Also remember to go to our Gold Plus page for exclusive weekly interviews with Ted Butler and Gana, and the business page for Barry Ritholtz, author of Bailout Nation.